Dean and Tyler Listle are registered investment advisor representatives. Investment advisory services offered through Brokers International Financial Services, LLC, member SIPC. Brokers International Financial Services, LLC, and Secure Retirement Solutions, LLC are not affiliated companies.
It's time for Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. Now, here are your hosts, Dean and Tyler.
Good morning, and thank you for joining us today. Tyler and I will discuss topics that affect your retirement, such as investments, income planning, Social Security, and much more. How are you this morning, Tyler?
I'm doing great, Dean. How about yourself?
Good. We're doing well. Unfortunately, the market isn't, and a lot of investors are taking it on the chin and letting emotions come into play here. It is a very emotional time when it comes to your investments, especially for those people who are retired and have worry and fear about the market and what they're going to do. So today we're going to talk about the coronavirus sell-off and what you can do to help your portfolio. You don't have to just sit there and wring your hands. There are some proactive things that you need to do, not relying on your advisor, not relying on anybody else other than yourself too. So we're going to talk about some of those things. But first of all, we need to understand last night President Trump was on the air and talked about a ban of travel from Europe. That sent futures down substantially. And, unfortunately, it looks like it's going to be another rough day in the market. However, let's talk about things, such as, financial stimulus. Is that really going to help the market? We are in such a low interest rate environment right now, and it's created substantial corporate debt over the last 3 or 4 years, because when interest rates are low, you can borrow money. And of course, when you pay it back at a low interest rate, it's much more advantageous than higher interest rates. So the corporate debt has been racked up. And now you have this coronavirus, which is stopping, supply chains, and it's stopping sales and revenue. So, we really haven't seen the negative side of that yet. We're seeing the health side in the scare that's coming from the health issues. But when it comes to slowing down of the economy, we do anticipate seeing that in the second and third quarter of this year. But you also have to remember the U.S. economy is pretty resilient, and being that it was chugging on all cylinders here the last couple of years, there is some room for this to happen without pushing the economy into a recession. We could see some recessionary numbers, but I don't believe it would be that deep. So, when we look at things like this, a lot of people are wringing their hands, wondering what to do next when it comes to their own portfolio. The largest population of retirees is upon us, and that's the baby boomers. And if you're fully retired, there's some ways we have to look at your portfolio, which is going to be different from those people who have a time horizon, which is 10 years or more. But you do have to understand, we have short memories. The market works in ebbs and flows. The unfortunate thing here is this sell-off was so dramatic that many people were caught not being able to make changes as the momentum of the market started to drop. We had 1,000-point swings, unfortunately more negative than positive, in 2-day increments. So that's why it's imperative that portfolios are constructed with this in mind before the event. Okay, very important. So let's look at things, understand too that the market itself is not your portfolio. People are looking at the market and they're saying, okay, we're hitting bear market territory of 20% or more down in one of the three main indexes, or all combined. And they're anticipating that their portfolio is reacting the same way. If your portfolio is down more than the market right now, that shows a tremendous either lack of diversification or speculation on some of the investments. If you have a diversified portfolio and you have large, mega cap quality companies represented in there with some cash and with some bonds, you should not be taking a hit as much as the market, though you are going to be down. You are not going to take a contrarian approach. When the market's down, you're not going to go up. When the market's up, hopefully you don't go down. Tyler, anything else here that we should talk about just as far as the basics of the Corona sell-off?
Yeah, Dean, when we talk about the basics when it comes to the coronavirus sell-off and what we've been seeing lately, the number one thing to understand, and many people don't realize this, but the market is not your portfolio. There's people that they hear on the news that the Dow drops 2,000 points in one day, and they think that their accounts lost 10% plus in one day. It doesn't work like that. Typically, portfolios, they have less gain and loss versus the market if you're diversified. Now, it's important to note that being diversified, it doesn't guarantee a profit or protect from loss. But through March 11th, from the beginning of the year through March 11th, the S&P 500 was down over 15%. So that's the index. That is the 500 of the largest U.S. companies on the stock market, down over 15% through March 11th. If you have a diversified portfolio where you have anywhere from 40 to 60% stocks and 40 to 60% bonds, you were down right around 5%. Some maybe even a little bit less, like 2 or 3, some a little bit more, like 7 or 8%. But if you were diversified, you were down right around 5%. So it's very important to note that one of the major things is you can't just listen to the news, and when they say that the stock market is down a certain percent, you can't right away think that your portfolio is down that percent as long as you're diversified. So that's the other important thing when we talk about the coronavirus sell-off and what's going on in the market right now. It is a big reminder as to why it's important to be diversified in the first place. Because what I saw is there were some people who they're in their 70s, they're retired, and they're taking money out of their account. And in 2019, they made 20% in a diversified portfolio, but yet when the market was up 29%, they had a problem with that. And all of a sudden, when we have this coronavirus sell-off and the market drops over 20% from the high point, then they're pretty glad that they were diversified in 2019. So being diversified, it prepares you for times like this where whenever there is a big sell-off, you're not taking the full loss of the market. So that's the number one thing. Is it's important to mention that the market is not your portfolio. You want to go and you want to know exactly how you're allocated, because your own portfolio oftentimes is going to perform differently than the market. And Dean, like you had mentioned, if it doesn't, if your portfolio loses more than the market, then you need to take a long, hard look at your diversification or lack thereof.
Yeah, there are a couple other things I want to add to what Tyler was saying. And again, a plan in place before a sell-off happens is imperative. Again, the reason for carrying cash is twofold. If you're retired, you need to withdraw, so you have to sell some positions in order to build up cash to withdraw cash. That's number one. Number two, it gives you one of the most significant opportunities to be able to buy in when the market stabilizes at a low, so you can get out of the trough quicker than maybe the market itself. So that's very important. Bonds are really no fun. I mean, they're pretty boring. People don't usually like them, especially when the market was, hitting on all cylinders. People didn't like the fact that they were carrying bonds which were flatlining. But bonds are put in a portfolio to be able to stabilize a little bit and to be able to be sold off to create cash to buy equity positions and then rebalance the portfolio and replenish some of the bonds too. So those are important things. The other thing too is if you don't have a financial plan, get one. Meet with a financial advisor that'll put a plan together. We put financial plans together complimentary for anybody who comes in the door. Part of the reason is we need to see your whole financial and debt situation before you can make recommendations. But again, go in there and you're going to have expenses. You should have your expenses all laid out. How much do you pay on a monthly basis? So take it upon yourself. This is your money. This is the money that you're supposed to live off of for the rest of your life. You need to look at it seriously, not just rely on all the other factors to come together and just recover and your portfolio is going to be fine. That's not how it works. Look at your expenses. Are your expenses in line? Two things have to happen when the market is down like this in order to help recover, and that is you either need to make more money to put in or you need to cut expenses. Well, if you're retired, you can't put any more money in because you're retired. So that means you've got, one thing that you can do proactively to help your portfolio, and that is cut expenses if you're withdrawing from the account. So look at that. The other thing too with your financial plan is look at your expected rate of returns. When we put financial plans together, we typically put in there a 5 to maybe a 6% rate of return expected over your lifetime. That is not to say that's what we want to try to get in your portfolios for you. We're just saying that if you're going to base your retirement on a financial plan, you better look at everything, including low rates of return for the rest of your life if something should happen. So if you, again, had double-digit returns last year and you are down this year, if you look at a 2-year average, where are you sitting? You should still be favorable yet. Now, we don't know what's going to happen for the rest of the year because we're only in March of 2020. So we do understand that. But you need to look at your expenses. The other thing we want to talk about is if you have less than 10 years time horizon are withdrawing, we talked about stay diversified. Don't sell into the teeth of weakness. We've heard people call in, email us, have meetings and say, should we sell off? No. At this particular time, you don't want to do that provided you had cash in your portfolio before the market started coming down. There's no reason to do that. We need to dig our heels in. And if you stayed with large quality investments, chances are, just 2 months ago when they were doing fine, they're going to do fine again. We need to get through this bump, though, which has been a significant sell-off. But to sell now when your portfolio is down double digits is probably not going to help you. And not to sound cliche, but there's the old saying, and sometimes the best move is no move. And you need to take the emotion out of this and just look at pure numbers. And it's easy to let emotions come into play, but you need to pull back from that. So again, what are you going to do to help your portfolio too? What we're going to do is have cash built up, wait until the time is right, the momentum starts to show that we're either flatlining or the bottom has already been hit. We need to see some sort of direction. Right now, there's no direction. The market is up 4 points or 4% one day, down 7, up 2, down 4, down 5. There's no direction there. So do we want to buy in consistently? No, not unless you have a 10-year time horizon or more. So the things that you need to do to help your portfolio, again, look at cutting your withdrawals. Do you need all of the money that you're currently taking now? Are you able to, put off some major purchases? One that a lot of people don't like to think about, but let's face it, this is, serious and you need to look at it, and that's get a part-time job. If you're retired and you're bored and not doing anything other than watching TV, you could probably handle a part-time job. By getting a part-time job, we can reduce your withdrawals until the market starts to recover and your portfolio does too. And the other one that a lot of people don't like to consider, but it's part of a plan that you need to look at, and that's possibly working longer. For those people who are looking to retire this summer, you might want to put it off another 6 or 8 months if you have the ability to do so. Tyler, what else am I missing there?
Yeah, Dean, you covered a lot of that pretty well. One thing that I want to go back to is having a plan in place before a sell-off happens is what we that's something that's very important, especially when we're talking to clients who are retired. And I know we reiterate it all the time that we always like to have cash and or bonds in the portfolio, even when the market's doing well, for times like these. So that way it allows for a buying opportunity and we're not all in the market, meaning that we are diversified. Because during a sell-off like this, we see that obviously it's driven mainly by the coronavirus, but it is also a political year, as everyone knows, 2020, and that's something that's been affecting it too. Just a couple weeks ago when Biden won Super Tuesday, we saw the market get a really big bump from that. So that goes to show that it's not only the coronavirus, there's a lot of other factors that are coming into play here with it being a political year. And then more recently, there's a lot of turmoil in the oil business. So Russia and Saudi Arabia, they're having a price war right now, which is driving down the price of oil, really hurting oil stocks, and the market reacted negatively to that as well. So whenever you have all these things that come to fruition at the same time, you're going to have a sell-off like we're seeing right now, obviously led by the coronavirus. And that's why having cash, having bonds, having a plan in place before the sell-off happens is very important. Now, again, that's especially when you're retired. For those people who aren't retired and who have a long-term time horizon, for people who might be in their 20s, 30s, 40s, even 50s if they're planning on working for a while yet, it's actually a buying opportunity where some of our younger clients, what they're doing is I like to call it, they're trickling money into the market, meaning they're not going and they're not taking all their cash and buying in, but they're slowly buying in just because no one knows exactly when we're going to hit the bottom. But once we do, we're going to see a bounce back upward. And a good way to play that is by simply buying in slowly, and that's something that you can't do unless you have cash in the first place. So that's why it's important that we do have cash in the first place. And Dean, you also mentioned that if you have a timeline of less than 10 years, a time horizon of less than 10 years when you're going to be withdrawing from the portfolio, or if you're withdrawing from the portfolio now, typically the last thing that you want to do is cash out and go to all cash, just because that is going to hurt you. As you mentioned, Dean, you're then selling into the teeth of weakness if you sell off at a point right now when the market is already down over 20% from the high point. So that's something where you typically don't want to do that. Now, unfortunately, there's people that do end up doing that, and those are the ones that are hurt the most over the long term when the market bounces back, because now they don't get the growth when the market bounces back. But to avoid that altogether is going back to having a plan in place before the sell-off happens. Have some cash, have some bonds, especially if you're retired. If you're younger, you don't necessarily have to have bonds. You can use it more of a buying opportunity, and that's what some clients do. Other clients continue to hold cash and wait till we see some more momentum when the market's going up.
Okay, we're going to take a quick break.
You're listening to Dean and Tyler Listle, investment advisors with Secure Retirement Solutions located on Allied Street in Green Bay. For a complimentary review of your current investments, or if you have questions, please call them at 920-347-9888 or go to their website at srsplans.com.
Okay, let's continue to talk about those people and what you can do and how you can invest now if you have a time horizon of 10 years or more before you need the cash. As Tyler said, buy in slowly. One thing even prior to that, we hear of some people just starting in the workforce and they haven't started their 401k. You need to start it. Get the 401k started as soon as possible and get started investing in dollar cost averaging when the market is low, because over your lifetime of working, you're going to find out that the shares that you're buying now at a low are going to increase substantially more than if you entered the marketplace and started your 401k when the market is high. So get started with your 401k. Also, increase your contribution. For those people who say that, my employer's got 3% and I am matching up to 3%, well, that's fine, but when the market is down like this, you need to increase that contribution or take your decision outside of your 401k and get an IRA started. We still like to tell people while you're working, we like to target 15% of your income should be going into retirement and savings accounts. So again, try to increase that when the market is down. A couple other things, Tyler was talking about momentum with stocks. People are saying they want to start investing right now. Where should we start? Well, first of all, there's a huge opportunity with all of these companies that have had their stocks go down, some as deep as 50 and 60%. But not all companies in stocks are created equal. Some of them are taking more of a hit because not only are they being hit by the coronavirus sell-off, but they also might be hit by the what's going on with gas and oil prices. So you need to look at things, and again, if they had somewhat positive momentum before the sell-off, chances are within the sell-off they're going to recover with some of that momentum. An example here is just prior to the sell-off, we saw consumer staples doing very well because people felt we were at the peak of the market. And let's be honest, when it comes to the corona sell-off, people are still going to need things like toilet paper and Clorox bleach and things like that. So if you're looking for an opportunity, good dividend production out of things like, again, Clorox, Church & Dwight, Procter & Gamble, some old tried and true consumer staples. Another one you might want to look at is consumer discretionary. If people are staying home as a result of the coronavirus, they're still having to buy if they don't want to go out and see the crowds at Costco and Sam's Club. Things that are online. Walmart has a great online opportunity and is growing by the day. Amazon and so on. So some of the consumer discretionary we think is still a good opportunity. And we're also very bullish on tech yet. Apple, Microsoft, Adobe. Again, these are things that, no matter how bad the market gets and how bad each day might get based on the market, you still see everybody working off of their phone. As a matter of fact, even more when the market's down like this, some people are absolutely obsessed with seeing what their stock's doing on a minute-to-minute basis, which is the wrong thing to do. So you look at things like that as far as being able to buy. There's a tremendous amount of stocks there that are on sale.
Yeah, Dean, really, really good points there. But one thing that I also wanted to add in as well is when we talk about the market going down like this and we talk about buying the dip, we've actually had past radio shows on that, on buying the dip. And this is exactly what that is, where we're seeing a big market dip here. And it's not market, I want to reiterate that it's not market timing, but we haven't had this opportunity in 12 years. Right now, the market is down over 20% from the high point. That's why we like to see people buy in slowly. If you have, some people have anywhere from 10 to 40% of their portfolio or more in cash, you don't want to go and try and time it and put everything into the market at the same time. What you want to do is you want to go and slowly take it in increments of anywhere from 2 to 5% and slowly go and buy in on the down days. And because again, no one can time the bottom. Even if you don't hit the bottom completely, if you're buying in when the market is 20% off the high point, but let's say if it were hypothetically to go down and bottom out at 35%, in 5 years from now, it's barely going to matter because you've still bought in at a low point. You still bought in 20% down from the high point. So you're still buying in by slowly trickling money into the market. Andy, you'd also mentioned that when you go and when you're trying to buy stocks, when we have any type of widespread market downturn like this, there's going to be a ton of stocks that are on sale, so to speak. So you have your options, but what we like to do is if there were stocks that were very good in 2019 and the last 5 years leading up to 2020, chances are they're probably still pretty darn good. So that's why we like to stick with stocks that have had positive momentum coming into a market downturn, such as some of the consumer staples that you had mentioned, consumer discretionary like Walmart, Amazon, Costco, Target, and then tech as well. Apple, Microsoft, you have a bunch of different stocks right now that are beaten up, that are beaten down. But oftentimes people try and get too cute and they try and buy some small cap stocks and stocks that they think are really beaten down. We tend to stick with stocks that have had more positive momentum leading up to the sell-off like this. Those are usually the ones that can bounce back and recover quicker. And again, we want ones that have had good growth in the past. Now, just because they've had good growth in the past doesn't mean that they're going to have good growth in the future. But the past is the best indicator of the future when it comes to stocks.
That's right. A couple other things, too. It sounds very confusing for those people with a time horizon of 10 years or more, again, before they need the money. We're saying that buying in is a good opportunity. You don't want to go all in at once. You want a dollar cost average in just like you do when you're working and it's going into your 401k. So you want to go in small increments because today might sound like a great day to buy in because the market's down, only to find out it goes down further tomorrow and so on and so forth. The other thing, too, is really we tell people when in doubt, when you're looking to buy in, when the market is down like this and you would like to see some momentum and positive growth over the years as a result of buying in low, there are a lot of different stocks. But when you buy a stock, you're putting all of your emphasis on one particular company. And that could be either good or bad. I mean, if you hit it right, it's going to do well. And if you hit it bad, unfortunately, your whole decision of buying in that one stock is going to go down. So this is where, when in doubt, look at index funds or index ETFs. The S&P, the Dow, and the NASDAQ are all down substantially. If you're looking to invest while the market is down, you might want to take an easier route, and that is go with an index fund. Buy a Dow Jones ETF, DIA as a ticker, or something like IVV or VOO, which is an S&P, or QQQ, which is NASDAQ. Look at those things and stick with it for a while. You're going to pick up the momentum of the index. And then as you start to do more research on particular stocks, then you can maybe go off once you're starting to pick up some gains and pick up some individual stocks. But we really like the idea of index funds or ETFs at this particular time until you can hone in on something.
Yeah, Dean, really good point there. because like I said before, right now there's a lot of different stocks that are on sale, so to speak, but if you buy into different index funds, you don't have to worry about trying to buy only 1, 2, 3, 4, 5 stocks that are the best. You can get a broad array of stocks by buying into an index fund whenever the market is down like this. So that allows you to have diversification to a bunch of different stocks that are low at this point. A couple other things before we close out the show here. You want to, just because they're beat up, just because they're down, you typically do want to stay away from sectors with poor momentum or issues other than the coronavirus, such as energy and petroleum. That's one that we've seen. And a lot of those companies are large cap. They pay dividends, but it doesn't matter if you pay a dividend because they can be cut. And if they're in a sector that is going by the wayside and a sector that is going the opposite direction of the growing market, that's something that usually you want to stay away from. So if it's a sector that hasn't been doing good when the market's been doing good before a sell-off, usually it's not going to do good after a sell-off. It's not going to rebound. So that's something, again, we usually see energy and petroleum. The oil industry right now is one that probably doesn't have a whole lot of momentum, even coming back from this, from the market bounce, once the market does bounce after the coronavirus settles down here. So stay away from those. And then lastly, now could be a good time to contribute to your IRA or your Roth IRA, or convert your IRA to a Roth while the market is down, because you can then convert an IRA. You might be able to limit the taxable gain that you can convert from an IRA to a Roth, and then once that money goes from your IRA to your Roth account, it's going into your Roth when the market's at a low point, and then you can get all that growth tax-free with it being in a Roth. So you're essentially buying into your Roth account at a low point. So again, now could be a good time to contribute and or convert your IRA to a Roth.
Okay, Tyler, good points. That's all the time we have this week. See you later, and hope you'll join us again next week.
We'll see you next week.
You've been listening to Secure Retirement Solutions with your hosts, Dean and Tyler Listle, fully licensed retirement specialists from Secure Retirement Solutions in Green Bay. To get more information from Dean and Tyler, contact them at Secure Retirement Solutions on Allied Street in Green Bay. Call 920-347-9888 or visit them at srsplans.com. Securities and investment advisory services offered through Brokers International Financial Services, LLC. Member SIPC. Brokers International Financial Services is not an affiliated company.